Welcome everyone to the first day of the webinar Directors' Duties and Sustainable Corporate Governance, organized by ECGI, the European Corporate Governance Institute. This three-half-day webinar is the first of a series of policy workshops that we plan to organize as part of one of the core missions of ECGI, namely to strengthen the dialogue between academics, legislators, and practitioners focusing on major corporate governance issues. The issues we'll discuss during these sessions are nowadays at the top of EU policymakers' agenda, not only EU ones, and they are also the focus of research by leading academics within and without ECGI. When we saw the report by Ernst & Young, that will be our focus, and we realized that it was the European Commission's clear intention to act upon it, we thought this would just be the kind of policy initiative on which many of our members would be able to provide evidence-based and theoretically sound input into the process. That is why we reached out to all our research members back in September, asking them whether they would like to be involved in ECGI initiatives on the report and the Commission's plans. Most of the respondents to our invitation will present throughout this seminar. A few of them had already decided to respond to the Commission's consultation, which was then open. Others were prompted to respond after our call for attention. Let me add that the fact that we invited people to volunteer to take an active role in this initiative, and this may sound like an excusatio non petita, explains the large prevalence of male speakers at this seminar, because only 2 women responded to our invitation, which doesn't even reflect the gender ratio among ECGI research members. And this is anyhow something that we are trying to improve, this gender ratio, in an environment such as financial economics and corporate law academia, which are still disproportionately male. And diversity in general is a goal that we have very much in mind. So let us now turn to today's program. We start with a presentation of the report by Ernst & Young. We invited both the European Commission and Ernst & Young to speak at the start of the conference. I regret to report that they both declined. And therefore, it will be ECGI's Executive Director, Marco Becht, Professor of Finance, and the Goldschmidt Professor of Corporate Finance at the Solvay Brussels School, Business School, to summarize Ernst & Young's report. Marco, the floor is yours.
Thank you very much, Luca. Now, I'm, of course, a very weak stand-in for EY and the European Commission. So what I will try to do is, first of all, try to give you from a reading of the report the overall policy objective, but then also remind ourselves how we got to the report and where the report fits into the ongoing program of policy making that the European Commission is pursuing. Then, as Lucas said, I will try to provide a succinct summary of the report. And then I think Luca is going to talk about the latest initiative, which is a new consultation that is ongoing at the moment, which is also important. Now, all stories have a beginning. So you remember that in the case of the Bible, God created the heavens and the earth. And at the beginning of this story, there was something very similar called the UN Sustainable Development Goals. So I'm mentioning this, they were signed September 2015 because they're an important marker for us. And what we're doing really refers directly to these Sustainable Development Goals. And one goal, of course, is of particular importance, which is climate action and climate change. And just as a reminder, this comes from Climate Action Tracker, we have the challenge of staying in that green range. And with the Paris Agreement that was signed in April 2016, we might just about manage to keep this almost manageable. But there's the red and the extinction zone also marked on this graph. So this is what we're really talking about. So this is the ultimate. So these two things are the goals of what this program is actually about. Now, after the signature of the Paris Climate Agreement, the question was, of course, what can finance do to attaining
Marco, was it your intention to share slides, because we are not seeing them?
Oh, yes, they must have. I thought I was sharing them. That explains something. Okay, so this is the outline, and can you see them now, Luca? These are the Sustainable Development Goals. This is the Climate Action Tracker, and I then talked about the Paris Agreement, which was signed in April 2016. So from here, the question was, what are we going to do in terms of finance? How can finance contribute to these goals? And then the Commission created something called the High-Level Expert Group on Sustainable Finance. Now, if you remember, this is a long practice. The Commission created in the past groups of wise men, for example, the Lamfalussy Group, but it has also in the past created these high-level expert groups to give it advice on particular upcoming topics and policy areas. And that's what the group did. It was created at the end of 2016, and it produced a report by January 2018. And then the European Commission very quickly reacted. In March, it adopted an action plan to put into action what the group had recommended. Now, the action we are focusing on here in particular is action number 10, which is labeled Fostering Sustainable Corporate Governance and Attenuating Short-Termism in Capital Markets. And there were two subsections to this action 10. The first one, which is our focus today, and I'll read it to you: to promote corporate governance that is more conducive to sustainable investment, the Commission will carry out analytical and consultative work with relevant stakeholders to assess: 1, the possible need to require corporate boards to develop and disclose a sustainability strategy, including appropriate due diligence throughout the supply chain and measurable sustainability targets, and 2, the possible need to clarify the rules according to which directors are expected to act in the company's long-term interest. Now, this was given to DG Justice, and the second goal, the second action in action 10, the Commission invites the ESAs, which stands for European Supervisory Authorities. We asked to collect evidence of undue short-term pressure from capital markets on corporations. The second part was therefore handed over to the European Supervisory Authorities, and they delivered at the end of 2019 3 reports, which are available and you can read, and I recommend reading them. We are not going to discuss them in particular detail today. Now, the ESMA report identified 6 particular areas where, from a review of the financial literature, it identified undue short-termism. And you have them here, I'm not going to read them out, which set a marker of what such undue short-termism might be. Now, turning back to the European Commission, DG Justice then organized quite quickly in January 2019 a stakeholder conference, which included many people, and all the proceedings are online, and the slides and the recording, so it's public record and you can watch it, listen to it. Now, there was academic input from 2 colleagues. One is Beate Sjerfel from the University of Oslo. She had just completed a multi-year project on clarifying the role of the corporate board. It was called SMART. Actually, the project was called Sustainable Market Actors for Responsible Trade. And she presented, and this project, since it was European Commission funded, is quite influential also in the report we are discussing. The second piece of input came from Will Leshonick. He's published extensively on short-termism in the US. Now, if you ask where Bill is in the spectrum of academics, he's probably not your median financial economist. And he also played a very important role at that meeting. Now, next, what happened, of course, is that we had a new European Commissioner with Ursula von der Leyen coming in, and she really set down 2 markers. So 2 of her 6 priorities, or 2 top priorities, were a European, or are a European Green Deal and an economy that works for people. So this topic was really moved to the very top of the European Commission's agenda. So it is of really first order significance. Now, the European Green Deal was then published at the end of 2019, and it contained the document, the communication, contained specific reference to the corporate governance framework and sustainability. The next document was published later in this year, in 2020, as a result of COVID. It's called Europe's Moment, Repair and Prepare for the Next Generation. Again, it contains reference to what we are discussing today. And in fact, it went a bit further because it said that the Commission will put forward a new initiative in 2021 on sustainable corporate governance. So before I then turn to the, or maybe I'll do it the other way around. So where do we then fit the EY report? Well, the EY report fits into the overall consultation with stakeholders under the Action 10. And it is really the centerpiece of what is referred to, or what is necessary whenever the European Commission engages or embarks on a potential legislative proposal, which is that has to involve an impact assessment. This comes out of the better regulation guidelines of the European Commission, and it is part and parcel of the process. Now, this is very good from a scientific point of view. It's evidence-based policy making, and the process, I'll just read the first 5 questions to you, involves answers to the following questions. First of all, what is the problem and why is it a problem? Secondly, why should the EU act as opposed to the member states or nobody? What should be achieved? What are the various options to achieve the objectives? What are their economic, social, and environmental impact, and who will be affected? So very worthy questions. Now, the EY report is important because it contributes to actually answering or trying to answer these questions. So it's very much part of the impact assessment that's necessary. The consultation that Luca was talking about is here in orange. So that closed on the 8th of October, and the results are going to feed back, or are going to feed in to that box on the right, which is the Sustainable Corporate Governance Initiative, which is supposed to be, well, there is a decision that needs to be taken whether it's going to be adopted. But as I read to you, the work program already commits that the Commission will do something in 2021. So legislation on sustainable corporate governance will be proposed. The other 2 pieces of input, the other 3 pieces of input that will go into this is one, a separate study on the supply chains, and a consultation on a renewed sustainable finance strategy that was launched after the high-level group had finished. And finally, there's the consultation that Luca is going to talk about at the end, which is ongoing. So quite a lot of input that's going to go into this Sustainable Corporate Governance Initiative. So the EY report, as I said, is important because it is the sort of main substance of this process. So what does the report contain? So first of all, the starting point of the report, and this comes from the abstract, is the statement that the focus of corporate decision makers on short-term shareholder value maximization rather than on the long-term interests of the company reduces the long-term economic, environmental, and social sustainability of European business. So that's the starting point. Then comes the objectives, or the objectives of the report. The objective of the study is to assess the root causes of short-termism in corporate governance, discussing the relationship with current market practice and the regulatory frameworks, and to identify possible EU solutions, also with a view of the Sustainable Development Goals and the Paris Agreement, as I mentioned in the beginning. Now, how does the report achieve this? Well, first of all, it introduces an empirical methodology, and the objective here is to assess whether there is short-termism or not. And the way this is done is by saying short-termism can be assessed by looking at the evolution of the amount of net corporate funds being used for payouts to shareholders compared with the evolution to the amount used to the creation of the value over the life cycle of the firm. So I'll not go very much now into this methodology. I think that a lot of the commentary has been also related to this methodology, so I'll not comment on it now, and I think we'll hear more about it as the seminar progresses. Now, the results were, in short, that based on the methodology that was proposed, the report does find short-termism. So data indicate an upward trend in shareholder payouts with increased fourfolds, and there was CapEx and R&D investment to revenues that have been declining since the beginning of the 21st century. But there's, of course, more in terms of the empirical findings, and again, I think people are going to comment on this. Now, once the report establishes that there is short-termism based on this empirical methodology, it then goes to the core problem, or it identifies the core problem, and the core problem is defined as followed. EU companies tend to prioritize the short-term interest of their shareholders over the long-term interest of the company and fail to fully account of sustainability risks and impacts. So this is the core problem. And in terms of the impact assessment, this is the problem that needs to be addressed. Now, what are the consequences of this problem? Environmental degradation, persistence of human rights violations in the supply chain, and companies don't have the resources to invest into achieving the sustainability goals, and overall underachievement on delivering the sustainability goals and the Paris Climate Agreement. So note, the causality goes from the core problem, which is short-termism, to these consequences. So then, once you've identified the problem in the impact assessment methodology, you have to identify the drivers, or what causes the problem. And the report identifies 7 drivers of these problems. I'm not going to read them all to you. They are very well spelled out in the report. Let me just give you one example. So the second driver that's being identified is growing pressure from investors with a short-term horizon, which contributes to the board's focus on short-term financial returns to shareholders at the expense of long-term value creation. Now, how does the report arrive at these 7 drivers? Well, there's a very helpful table 4 which sets that out. And in the case of my example just now, there are 2 factors, which is change in ownership structures and emergence of activist investors, and disclosure of quarterly returns on existing guidance. And this was identified from a review of the literature. Now, in other cases, there was also a legal review and a survey of about 110 respondents to a questionnaire. So once the 7 drivers were identified, issues were associated with each of these drivers, and I just read the 2 issues associated with the second driver of growing short-term pressure growing pressure from short-term horizons. I just read those to you before. Now, when you assemble all of this, you're going to get a graph in the end, but before you can do that, you have to take into account the other dimension of the impact assessment, which was the question, is EU action required or not? And the report then distinguishes between 3 3 scenarios: no EU action, no legislation with 2 sub-options, and then to legislate. So when you put all of this together, for each of the 7 drivers and each of the issues, you are getting an analysis based on these 2 levels. So, for example, in this case, and I'm just giving you what would be the legislative hard proposal that corresponds to the first issue of the second driver, would be a Commission proposal to amend the Shareholder Rights Directive to introduce binding rules requiring member states to introduce mechanisms to incentivize long-term shareholder periods. So the full picture that then emerges is 7 drivers, 12 issues, 36 policy options. And for each of these, the report, again in line with the impact assessment methodology, needs to assess the potential impact and also effectiveness and all the rest of it. And the report does this. So there we are. That's broadly speaking what the report contains. And let me stress again that it's important because this map, which has this behind, which then results in this for all the drivers and the issues, potentially feeds into this 2021 proposal on proposing legislation on these issues. So the question for us is, first of all, is the problem that was identified, namely this core problem, is this the right problem that we should be addressing? Secondly, even if this is the problem, do we agree that there is, what's the analysis of the problem? And then once you have the analysis, are the policy options, are these really the drivers and are these the issues? And then are the policy options that are being proposed the ones that are needed in order to fix any of this if it really needs fixing? So a pretty broad agenda. And as I said, the stakes are pretty high because we have an important, very important goal. But if we get it wrong, we might actually be doing damage and not achieve the goal. On the contrary, we might be going away from achieving the goal rather than achieving it. So Luca, I finished now, and you might want to say a few more words about the ongoing consultation, which is going to last until the 8th of February 2021. So people have the chance to submit further, make further submissions to this one until the 8th of February 2021.
Thank you, Marco, for your summary of the report. So clearly enough, there will be a lot to discuss in terms of the methodology chosen by Ernst & Young, their empirical findings, the policy implications, and the policy recommendations. In the few minutes that separate us from a short break before the keynote speech, I'd like to draw your attention to the current phase, as Marco said, of the policy process at the EU level, because the consultation on what to insert into the proposal is open, and the following step we will draw, of course, from the consultation results. The consultation is in the form of a number of questions, which are summarized in a couple of slides. Marco, if you can. Yes, so first of all, there is a requirement that companies and their directors, a question whether there should be a requirement for companies and their director to take account of stakeholders' interest in corporate decisions. In addition to that, there is a question about whether the requirement to act in the interest of the company should be clarified to include other stakeholder interests and even collective interests, such as societies, possibly, and the environment. Of course, these are questions, so there is no statement that this will be the case according to the European Commission. There is this question whether companies should themselves identify who their stakeholders are, and there is a potentially relevant requirement that is being consulted upon about whether companies should set up adequate procedures and where relevant measurable targets to ensure that possible risks and adverse impacts on stakeholders are identified, prevented, and addressed. So in other words, an extension of risk management duties to address risk for all stakeholders. Next slide, please. And then there is this question about whether a duty to balance the interest of all stakeholders should be recognized as part of directors' duty of care. There is an additional question about whether stakeholder should be given a role, possibly standing to sue, in the enforcement of directors' duty of care to give substance, of course, to this broadened duty of care. Based also on a different report on supply chains, there is also the question of whether there should be a requirement to establish and implement adequate processes with a view to prevent, mitigate, and account for human rights violations, health and environmental impacts, including relating to climate change. Then there is, sorry, can you go back a second? There is this question of whether there should be a duty to engage with stakeholders, whether there should be governance mechanisms for this purpose, and finally, question on whether remuneration practices should be reformed so that they are consistent with the goal of sustainability, and whether buybacks should be limited. So I would conclude by noting that what we are ultimately discussing in these 3 days is a report that serves as support for what may possibly become one of the most ambitious corporate law reform agendas, for better or worse. We'll discuss that, ever advanced anywhere. I think one can say that, because these changes would be really fundamental. And therefore, it's important for us to have this discussion and to consider all the available evidence, both as gathered by Ernst & Young and as available elsewhere and as produced by financial economists, as well as the inevitable trade-offs and side effects that this kind of reforms may entail. So as you see, there is time until February to respond. And that's all for now. I think we have a break in our program. Marco, unless you would like to add something, I think we can.
No, I thought you provided a very good summary, Luca, and maybe we start at in 15 minutes with Zacharias, so at 3:15, and reconvene with Zacharias' presentation of what do we know about short-termism.
Excellent. Thank you, and see you soon. Okay, welcome back. And so our keynote speaker for the event is Ladika and Sautner, Professor of Finance at Frankfurt School of Finance and Management, who has written extensively on the topics covered by the report. Zach, the floor is yours, and you can answer the question in the title, what do financial economists know about short-termism? Thank you.
Thank you very much. Just to make sure you can hear and see the slides.
Yes.
Perfect. Okay. Yeah, I would like to thank the organizers for the opportunity to talk about this topic. I think it's a first order topic, and I appreciate the opportunity for us as scientists in this area to share our views and the views of others as well, right? Because of course, what I'm doing here is I'm building in this talk on the evidence generated by lots of people. Many of them are actually here in the audience today. So when I was asked to prepare this presentation, I tried to write down a few guiding principles that I wanted to follow when putting these slides together. And the first principle that I tried to follow was, trying to be balanced without, a prior opinion on the answer of the question. I also tried to build on what economists have been calling the credibility revolution. That is significant progress that has been made in science and economic science to move from correlation to causation. So I think getting evidence that tells us something about causation is highly important in this context. Because we care about policy advice. And when we care about policy advice, we need to understand whether the evidence that we have tells us something just correlational or whether there's causation in it, because that's what policy advice is after. We want to make sure that if we change things, that it has a causal effect as well. Third, I try to build mostly on empirical micro evidence. Now, what's the reason? Well, I'm convinced that it's very difficult to infer causation from aggregate, from macro relationships. Now, think of the relationship between buybacks and R&D, macro relationships. If we show how these variables trend over time and whether there's a correlation in the trends or not. Now, what's the reason that it's very difficult to infer causation from this? Well, because we tend to not know the counterfactual, right? Suppose you find that buybacks go up, R&D goes down. Now, we don't know whether that's causal because we don't know what would have happened to R&D if buybacks would not have evolved as it is, right? And of course, what I also try to do is build as much as I can on high quality research, which is research that has been peer reviewed by others, by referees, by editors, which is published in top journals. And of course, there are some exceptions that I'll also indicate as I go through the presentation. So it's vetted research, if you want, that has gone through the scientific progress of making sure that there are no major flaws in the analysis. I should also say at the end, another guiding principle was, being humble and aware that I've missed certainly some work, some of your work. I've seen who's in the audience. Lots of people have worked on this as well. And due to the limited time, I couldn't speak about everything. So just to make sure we're all on the same page, what do we mean as financial economists when we talk about short-termism? Well, it's actions that focus on the short-term gains at the expense of long-term value. So there are at least the following elements. There are some actions, usually actions by management, the CEO. It could be investment decisions, it could be payout decisions. There's some form of long-term value destruction. And there's a focus on short-term gains, usually on short-term earnings or the short-term stock price. Now, just to be on the same page also with respect to the last point, there is some notion, usually, not always, but usually that some market inefficiency is required for short-termism to play a role. What's the reason? Well, suppose a CEO cuts R&D and increases short-term earnings at the expense of long-term firm value. In the perfect world with perfect foresight, very efficient financial markets, the stock price should reflect that possibly long-term effects are damaging and more damaging as the short-term gains. So therefore, the short-term stock price should actually decline. right, in anticipation of all the things that happen. So if we have a narrative that cutting R&D increases the short-term stock price because it increases short-term earnings, there's some notion behind that it may be that the market's not fully understanding what's going on. Now, I try to draw up a little map here when preparing for this presentation in order to kind of illustrate for me what the driving forces are. In the middle is the CEO as our representative of the company, the executives. And you see here on the right of the slides, the CEO is making investment decisions, R&D, CapEx decisions, decisions on buybacks, and other decisions. And these decisions may affect the short-term or the long-term stock price. Now, the CEO is acting based on incentives. So we're moving to the left, based on possible engagement by shareholders. So who is setting incentives? Who is providing engagement? Well, it's the SH, the shareholders in the company. And they can be private, they can be public. Right? It could be a private or public firm. They could be long-term, they could be short-term oriented, they could be activists, or they could be non-activists. So these are some dimensions that I'll speak about later. In addition, the CEO also, of course, reacts to incentives provided by analysts. Think of earnings per share targets, and responds to incentives because of financial reporting requirements. Think of quarterly earnings targets. So we're going to look at each of these elements in a second. So therefore, the agenda of what I'm going to share with you is basically three points. I'll look at evidence when it comes to executive compensation. So is there evidence that short-term incentives and long-term investment are related? Is there evidence that short-term incentives and long-term firm value are related? Then I move on to financial reporting. Is there evidence that the frequency of reporting affects long-term investment? Is there evidence that analyst earnings forecast targets affect long-term investment? And then I'll also speak about the role of ownership, shareholders. Do we find evidence that private versus public ownership matters, that long-term versus short-term ownership matters, and that activist versus non-activist ownership matters? Now, give me the evidence, you may say. So that's what I'm gonna do. I'll start talking about executive compensation first. So within executive compensation, as I just showed, there are essentially two areas that we're gonna see evidence on. So the first area is about short-term incentives and long-term investment. So how short-term incentives, hereby I mean CEO incentives, executive board incentives, affect long-term investment. And the key question here that we care about is, do concerns about the short-term stock price affect long-term investment? Now, how do we measure short-term incentives, short-term concerns about the short-term stock price? Well, what the literature usually does is it's looking at the amount of equity-based compensation that vests at a given moment, right? So options, but also equity is usually granted with some vesting period. So you get this as an executive, but you may not be able and allowed to immediately exercise and sell the underlying equity. So the idea behind these vesting periods is to give horizon incentives. Now, the challenge, the empirical challenge here is that short-term incentives are, of course, endogenous. They're set by the board. So the empirical literature has to come up with some ways to break this endogeneity. I will speak about three studies that provide us with evidence in this area. The first study is by Edmonds, Fang, and Llewellyn. It's published in one of the top journals in finance in the RFS in 2017. And what I've done here in the subsequent papers, I tried to give you a snapshot of the key results in these papers so that you get a bit of a feeling of the evidence, the hard facts produced by these papers. Now, what do they do to establish causality? So they're looking at equity that vests. And the idea here is that equity that vests has been granted years in the past. So it's not endogenous, as we like to say, to current investment opportunities, right? It's historically provided. And what the paper looks at is the large amounts of equity that may or may not vest in a given quarter, in a given year. So you see the evidence here. So when a lot of equity vests at a given moment in time, you see here within the red bar that R&D goes down, CapEx goes down, net investment goes down, right? So these coefficients are all negative. So if more equity vests, it induces CEOs to reduce investment. Now, the effects are meaningful. If you look at a 1 standard deviation increase in the amount of vested equity, it leads to about a 2.2% decline in investment here in the variable on the right. So it's about 11% of the mean investment to assets ratio. So it's a substantial amount. Now, it's not just that they document that vesting equities or short horizon, the manager leads to cuts in R&D. To kind of close the story, they also show that there are positive effects on short-term earnings. That's what you would expect, right? If you cut R&D, for example, it's leading to higher earnings. Plus, it positively affects analysts. It affects their forecasts. They're revising them positively because they're higher earnings. And it affects also the earnings guidance of analysts. There's a second paper that I've written with Tomislav Ladika, my co-author in Amsterdam. And we're providing actually very similar evidence, but using a slightly different setting. Now, what we're exploiting is a situation where, because of a change in accounting rules, a lot of equity vested for some firms from one moment to the other. So the cause of this was that firms, in order to avoid an accounting charge of option compensation that was provided, could accelerate the vesting periods. Acceleration of vesting periods means that rather than having to wait 1, 2, 3 more years for the options to become exercisable, they became immediately exercisable. Now, of course, in the paper, we have to address the challenge that the decision to accelerate options is endogenous. It's not random, so we can use in our empirical analysis the fact that the timing of option acceleration was, by the rule, a function of a firm's fiscal year end. So we're instrumenting, as it's said in this empirical in this empirical method, the decision to accelerate options. And then find that at firms where a lot of equity vests, we see strong declines in total investment, in R&D and CapEx, right? This is in columns 3, 4, and 5. Now, these are these regressions that control for the endogeneity in the acceleration decision. If you look at columns 1 and 2, where a naive regression is run, where we don't account for this potential endogeneity, you see there are basically no effects of option acceleration. So if you believe that this analysis is sensible, it indicates that it's very important to really carefully think about how to establish causality in order to answer this important question, whether option vesting affects investment. Now, what we also do find here in this paper is not just is investment cut when more equity vests, we also find that the earnings of the firm go up, which is probably the reason why investment is cut, plus the short-term stock price increases. Now, this is what the short horizon manager cares about. You care about a short-term stock price that shoots up because the vested equity allows you to exercise the options that became exercisable, so you can cash in the benefits from your myopic actions. Also here, effects are large economically. A 1 standard deviation increase in the fraction of options that are accelerated reduces investment rate by about 24% of the variable's standard deviation. There's a third paper that uses a different setting but provides similar evidence. It's a paper by Flammer and Benzel in the SMJ. It's one of the top journals in management. Now here they also use a very clever setting. So they exploit that shareholder proposals on long-term executive pay sometimes just pass or fail by a very small margin. And the idea is, at the shareholder meeting, whether it passes or fails at the small margin is pretty much random. So they're exploiting that for quasi-random reasons. Some firms implement, it's a shareholder proposal, so likely implement, if the management follows, long-term compensation policies. So they're comparing essentially these types of firms, those that just randomly happen to pass the compensation proposal, and those that they don't pass the proposal. Now, the key finding is here again in the red box, and don't look for stars because they don't report stars, because in some management journals, also econ journals, you don't report the significant stars, but sometimes just the standard errors. But the insight is still the same. There is a significant effect here. So there is an effect that the adoption of long-term compensation policy causally leads, because they have this clever experiment, to an increase investment in innovation in stakeholder relationships, right? So put differently, if you do not have these long-term incentives, long-term investment incentives, you have less investment in the long term. Now, what they also show in columns 1 to 3 is not just that, as shown in columns 4 and 5, investment is positively affected, but there also seems to be an increase in firm performance and firm value as a result of the long-term incentives. Now, there's another set of papers that look at the question whether short-term incentives affect long-term firm value. And this is actually quite challenging to do convincingly, right? To answer the question, how short-term actions of managers affect long-term firm value, which eventually is what we care about. And the reason why this is challenging is because isolating long-term effects of myopic decisions is confounded because all kinds of other things are likely to happen in the meantime before you can establish results for long-term stock returns, for example. Right, so examining them is challenging. Now, there's one paper that has a very neat experiment in order to answer this question, and it's a paper by Edmonds, Fang, and Huang. It's still a working paper, but still with a very clever empirical approach. So it's building on this earlier paper where they were looking, Edmonds and Coathers were looking at equity that vests at a given moment in time. And now what they show is if you have a lot of equity that vests, it increases buybacks by the firm, it increases M&A activity. Now, what they do here in the analysis is they look at the long-term effects of, in the top panel, buybacks, in the bottom panel, M&A activity that is induced by more vesting equity. And what you see here is if more equity vests and as a result you increase buybacks or increase M&A activity, then the long-term effects are more likely to be negative of these vesting-induced buybacks or M&A activities. Right? So column 4, 5, 6, 7 in the top panel that looks at buybacks shows that the long-term effects of the buybacks if more equity vests. Right? So it shows very clearly that these long-term buy and hold abnormal returns, long-term stock returns correcting for market movements and so on, are negative. Right? So it indicates for buybacks, but in the bottom panel also for M&A, that actions, M&A and buyback actions induced by short-term incentives tend to destroy value in the long term. Now let me move on to the second big topic, which is financial reporting. As part of that, I'll first talk about the frequency of reporting and how that relates to long-term investment. Now here the key question is, does quarterly financial reporting induce short-term behavior due to the focus on short-term earnings? And what the papers do is they try to identify effects here from changes in reporting regulation, annual, semi-annual, quarterly in the US, EU, and the UK. The first paper is by Kraft and co-authors in a top accounting journal. And what they use in order to establish the causal effect is the transition of US firms from annual to semi-annual and then to quarterly reporting. Now, this is a little bit, looking back in time, of course, because, it dates back to the 50s until 70s when all these things happen, but the effects are striking. So there's increased reporting frequency, and that is associated with less investment. You see it here again in the highlighted coefficients. You see that after the change to more frequent reporting, firms that now have to comply with the reporting requirements, others may have already complied with it or don't have to comply with it yet, spend less on capex and see a decline in property, plant, and equipment. And this is all also scaled by assets, so it's controlling already for any firm size effects. Right? So more frequent reporting seems to cause, if we believe in the setting, less investment. Similar evidence comes from another paper in the same journal by Ernstberger and co-authors. Now, what they're doing is they're looking at the European Union setting where there was an increase in the frequency of so-called interim management statements, right? It was moved to a quarterly basis. Now, what they're doing is they're comparing newly mandated firms that now have to comply with this quarterly reporting with matched firms, similar firms on all kinds of measurable dimensions that already were mandated to report quarterly. Now, what do you see here? You see here that these firms that now have to report on a quarterly basis, they increase real activities manipulation. It's a positive effect, right? After you have to move from semi to quarterly reporting. So that means that you may increase discretionary spending, for example, in order to change your behavior. Right, so there's more manipulation going on because of short-term targets, short-term earnings targets that you may have to fulfill here. Now, there's also evidence, and I promise to be balanced if possible, that indicates that financial reporting frequency is not so relevant in terms of affecting investment behavior. Now, there's this paper by Nala Reddy and others that exploit in the UK the start of mandatory quarterly reporting as requested by the Financial Conduct Authority in 2007, and also the end of that requirement in 2014. Now, what you see here is firms that are treated, so that these are firms that have to switch now to quarterly reporting and did semi-annual, for example, before, compared to firms that already report quarterly. They see no change in investment, be it CapEx, net PPE, or R&D, with one exception in column 2, but it's a small effect. Right, so their evidence suggests from the UK that mandatory reporting does not have a significant effect on long-term investments. Now, they also find, it's not reported here, that companies that voluntarily moved back, that was also possible, from semi-annual reporting to annual, from quarterly to semi-annual reporting, they did not show an increase in investment thereafter. Kind of what you would expect if it goes the other way around. Okay, so then there's also evidence that looks at whether analyst earnings forecasts affect long-term investment. And here the key question we want to have an answer for is whether quarterly earnings forecasts or EPS targets, earnings per share targets by analysts induce short-termist behavior. Now, the first evidence that was provided on this was based on a survey among top executives in the US by Graham Harvey and Raj Gopal in a top accounting journal. Now, I very much like surveys because, rather than having to indirectly infer relationships, we can directly ask the decision makers. So here you see the responses to the following question. Near the end of the quarter, it looks like your company might come in below the desired earnings targets. Within what is permitted by accounting rules, which of the following choices might your company make? And you see the top 2 choices that the respondents provided in terms of how they responded are decreasing discretionary spending, R&D, advertising, maintenance. 80%, a stunning number, said we are willing to do this. But also, more than 50% say we are willing to delay starting a new project, even if this entails a sacrifice in value. Right? So some evidence that managers are willing to respond to these earnings targets by analysts by potentially destroying long-term value. Now, more evidence on this comes from a very nice paper by Almeida, Voss, and Kronlund in the Journal of Financial Economics, again, one of the top journals in finance. And what they're doing is using a so-called regression discontinuity design. So essentially what they are showing is that firms, or what they're comparing is firms that are just about to miss an earnings per share target set by analysts, and those that just make it, and now look at firms that just miss the earnings per share target, but in order to not miss this, make a buyback. Right? So by doing this buyback, these firms manage to meet the earnings per share target. So the probability they show of a share buyback, which increases earnings per share, is higher for firms that would have just missed the target, the earnings per share forecast, without the buyback. right? So by doing the buyback, you make it, and they're comparing firms that just beat the forecast independent of whether they had to do this buyback or not, right? So we have two kinds of firms that are very similar. It's just that the one type of firms is doing a buyback to meet the earnings per share target, and they would have otherwise missed it. Now, what they show is that these EPS motivated buybacks, they lead to less investment, they lead to less employment. And that's what you see here in the columns: employment, CapEx, R&D for firms that would have had a negative earnings per share if they would not have done the buyback is lower, right? So there's a follow-up paper by Almeida et al. In 2020. It's a working paper where they're looking at the long-term effects of the incentives to engage in EPS-driven repurchases. And they show it leads to lower long-term productivity also, not just short-term investment cuts, but only if there are additional frictions that prevent firms from downsizing, reducing investment efficiently. So what are these frictions? Well, they show that if a firm has most plants in states with weak labor protection, the reduction in investment in unproductive, there's reduction in investment in unproductive plants. But if most plans of the firms are in states with strong labor, strong unions, then these cuts are inefficient, so not in the unproductive plans, but across the board, even if these plans are productive, right? So potentially damaging effects if we have strong labor unions. Okay, let me move on to the third topic, ownership. So first, I'll try to look at some evidence comparing private and public ownership. Now, there's a paper by Asker, Fari-Menza, and Lundquist in the RFS 2015, again, one of the top finance journals. What they do is they're comparing similar public and private firms, right? So you take a publicly listed firm, that's what we mean with public here, and you try to look for a similar firm in terms of size and other characteristics that is private, of course, same industry and so on. Now you compare the investment behavior. Now, the first result is they show that compared with private firms, public firms invest less on average. They have investment rates of about 7.5%. The private firms, and the publicly listed firms of only 4.1%. But more importantly, also, if you look at the changes in investment, that's what's in the figure here. What they show is, and these are the higher bars, that private firms have bigger changes in investment over time, right? It's not just that privately held firms invest more on average, it's also that the changes, independent of the years you look at, in these firms in investment are larger. Right? So the first key result here is private firms invest more and their changes in investment are also larger. Now, the other interesting result from the paper is they also show that public firms are less responsive to changes in investment opportunities. Right? So great opportunity comes up, the private firms are able to jump on and make the investments, the public firms not. And then let me speak a little bit about long-term versus short-term investors. Now, the evidence basically here is that the presence of short-term investors is associated, and I'm careful here because I think compared to some of the other studies, it's more difficult here to establish causality, is associated with less investment, with more frauds, more empire building, and worse M&A decisions. And I'll just show you one paper here by myself that looks at this. So what we are doing is, building on some other papers, among others by Boone, I think Audrey is in the audience here, that we're looking at Russell 2000 index inclusions as a shock to institutional ownership, right? If you add it to the index, institutional ownership goes up. And what we show in this paper, it also goes up for short-term, here called transient institutional investors. Now we're comparing the investment of firms that see, because of the index inclusion, large increase in transient ownership. And what we find is that their investment over the subsequent years, if we think about R&D and assets as the measure of investment, goes down, right? So if you have a shock to the horizon of the investors become more short-term, it seems to be associated with less investment. Not only this, we also show in this paper that earnings are R&D is cut, but earnings are going up, and the short-term stock price also increases of these firms. by the time that the short-term investors have left the firm, there's a reversal. Markets have learned that good investment was destroyed and the valuations of the firms are decreasing again. Now, in terms of the last point, activist versus non-activist, there is a lot of evidence that is actually, positive in the sense that we find, or the evidence by Alon Prav and co-authors in a series of papers, I think Alon is also in the audience, shows that the presence of an activist investor causes higher stock prices. That's good news upon the revelation that they have built a stake, more investment, higher productivity, and also a higher long-term firm value. Right? So very good news here. No evidence that activists are causing some form of myopic short-term behavior. Now, what I've tried to do here is summarize the evidence on the three topics. And, if something is red, it indicates, concerns, potential concerns, evidence of short-termism. If it's orange, it's indicating mixed evidence. And if it's green, it shows no evidence, right? So you see here already that we need a very nuanced picture, right? There is some evidence in some areas that short-termism happens, but there's also a lack of evidence in other areas. And this is also the bottom line. I think it's important, based on the research that I've been reviewing, to have a nuanced perspective. Short-termism is a first-order issue. I strongly believe this, but only in certain parts of the system. The evidence does not just suggest that the system is broken. Now, what is the cause of the problem? Well, shareholder orientation is not the cause of the problem. It's rather a lack thereof. Right? So we should not confuse the symptoms here with the disease or the underlying problem. For example, payouts are not the disease of the problem. Payouts may react to EPS incentives and meeting and beating earnings forecasts, but they are not the disease. They are just the symptom when other incentives are broken. So therefore, reform needs to address selective features of the system. One should try to fix the underlying problems, not the symptoms. That's what the evidence suggests. Now, let me also say a few caveats towards the end of this presentation. First, a caveat might be that there is publication bias, right? So you could argue top journals prefer to publish positive results where there is evidence of something, and non-results, no evidence of short-termism, may not be published. Now, journals are aware of this. They're making lots of steps in order to address this, but I think we should have that in the back of our minds. There may also be personal bias, right? I have papers that show evidence that short-termism in some areas, compensation matter, but certainly, I may be also biased in my views because of my own research. And finally, there may be sample bias. A lot of the studies, and therefore you see the globe here, come from US data, because it's more widely available, it's easier to analyze. And we have less evidence, still some evidence, from the European Union. I still think a lot of the evidence from the US can be applied here, but we need to be aware that maybe the governance system in some of the EU countries may be a little bit different. So keep that in back of our minds. Thank you, and I hope I stayed on time, and I hope my kids that were in the background didn't annoy you too much.
They were nice to hear. Thank you, and only occasionally, of course. Thank you, Zach, for your excellent presentation that sets the stage for the discussion that will start immediately. Every day we will give the floor first to ECGI members who responded to the Commission's consultation. Let me say that there will be time to discuss also Zach's presentation in the Q&A session. So I see that there are questions in the Q&A, but and for sure some of the panelists may also want to chip in, but we'll do that later. So now the first of our fellow ECGI members respondents, not only chronologically, the first is Georg Ringe, who is the professor of law and the director of the Institute of Law and Economics at the University of Hamburg, and a visiting professor at the Oxford Law Faculty. Georg, the floor is yours. Thank you.
Thank you, Luca. Let me just see whether this works. Okay, hello everybody. Thanks so much for having me, and it's a great pleasure to contribute to this debate. Thanks, Zach, for an excellent presentation. I will introduce briefly the submission that I did together with two colleagues to the EU consultation. So my remarks are essentially based on this submission that I did together with my colleagues Alex Bassen and Kerstin Lopata, both economists from the University of Hamburg. And as a sort of interdisciplinary team, we came across a number of issues that really deal from the richness of fields that are affected here. It's of course economics, it's of course law, but it's also, and importantly, politics. So I tried to keep those different elements nicely apart. Let me start with the positive stuff. So we firmly believe that the European Commission is to be commended for tackling the issue of sustainability. And it's very important to think about this as an externality problem in corporate governance. We also believe that the integration of those sustainability factors in decision-making does correlate with financial performance. That's sort of something where we have lots of evidence on, and that also focusing on the board level, as the European Commission is doing, is essentially a prerequisite for better CSR performance in the framework of corporate governance. However, I think the consultation also suffers for some minor or major, depending on how you look at it, shortcomings. And the key problem is the one of short-termism, essentially. So we've just been listening to the excellent presentation from Zach. I think essentially what this consultation is doing is, first of all, equating shareholder value with short-termism, right? Which I think is not legitimate to do, because the one is not the same as the other. And then it's mixing up in some ways the problem of sustainability and essentially externalities on third parties with the short-term problem, right? Which are also two different things. Now, short-termism, as we've just heard, is ambiguous, right? It can have negative consequences. It can also have a positive effect on many things. You know, in the traditional corporate governance debate, there are many different paths and perspectives that can be taken. We've just heard a lot of it, so I'm not going to focus on this again. And I think that other contributors later, no, not later today, but tomorrow and the day after, will focus on this in a lot of detail. So my remarks will not very much go into the short-termism debate, but I just want to underscore here, my main point is that short-term investors can be very useful, right? Also from a corporate governance perspective, in particular when they act together with long-term investors. And there is a growing trend that, for example, activists sort of partner and team up with long-term investors, and those together are then definitely a sort of additional monitoring institution, different monitoring view that can create value in monitoring the management and has an incentive to engage in corporate governance issues. But the bottom line here is that I think short-term is not necessarily the same as shareholder value, and long-term is not necessarily a proxy for a stakeholder approach, right? And this is, I think, something in the terminology that is sometimes conflated in the debate and is also in the EY study. A third problem is basically a one that is omitted here, which is that market pressure, which is usually associated in the study as a bad thing, can also have positive effects. And there is a growing trend of investor demand that is pushing towards the pursuit of ESG engagement, right? So that trend, to be honest, has been reinforced over the past several months in the COVID crisis, And there is a growing trend from specific activist investors that are asking for the pursuit of ESG activities and are benchmarking specifically for ESG goals. I mean, this is a relatively recent trend, so we can be charitable with the consultation and with the study of not having taken this into account to the full extent. But I think it's important to also understand investor demand as a force for the good, rather than just being responsible for short-termist pressure. And the submission from Fried and Wang very nicely debunks that assumption. Now, I believe that engagement activities usually address the board directly, either sort of in direct conversations or indirectly through traditional ways of general meeting or proxies. And this de facto is an important proxy, a substitute for improving sustainability at the board level. And this is something that I think is greatly missing from the European consultation. There's positive effect on this. And I think it's important to consider this as a sort of ideal channel for furthering the broader objectives of the initiative. So in other words, you don't need to fiddle around too much with the board, with board duties and board obligations and all of this. If there is already strong investor demand that drives towards the sustainability goals that the European Commission would like to pursue, you should rather then facilitate that type of activism rather than specify something in the legal framework. Which brings me directly to the legal aspect of the consultation, because it's important to consider a number of design challenges on how to go about what the European Commission wants to do. It's very important to consider the context of any legal intervention. Directors' duties, the sort of centerpiece of this consultation, are extremely vague, and we always know that they can be interpreted here that way, here that way, here that way, right? These are extremely broad sort of prescriptions that everybody can hide behind, and given the extremely low levels of litigation and enforcement in Europe, we know that they actually rarely play a role. Surprisingly low relevance in any sort of formal enforcement proceedings. This, of course, is due to the entire back framework that is associated with this, right? So we do not have significant number of class actions in Europe. We have largely prohibited contingency fees, which make litigation largely less attractive than in the United States, for example. Second point, the nature of the action that is proposed to be taken is completely unclear, right? It's not clear whether they want to pursue something in sort of legislation or just giving best practice guidance. I think, again, looking back at my earlier point of strengthening the investor voice, that is a goal that is going under here and is not adequately given weight. So stewardship and the idea of strengthening the voice of institutional investors towards pursuing ESG goals is something that will be a less dramatic, less drastic intervention into the corporate governance framework, and is also even supported now by a stronger role of central banks that are buying assets around the world with a sort of green finance ambition in mind. Which leads me to conclude that I think what we should consider, at least seriously, and which is really missing here, is a more facilitative approach to law, right? Sort of the report is really outlining hardcore old style legislation, which is restrictive, rather than facilitating things. For example, by market standardization, right? What is short term? What is long term, for example? What is ESG compliant? What not, right? All of this would dramatically improve market practices, would increase transparency, and would facilitate investor engagement towards those objectives. We could also think about much more innovative and dynamic tools of regulation, which can be updated much faster than the slow lawmaking machine, in particular on the European Union level, which takes ages to get into motion. And then once it's there, right, the standard will stay for this for the next 20 years until it's been changed again, which is, I think, in this very fast moving world, a very difficult thing. Which brings me to the final point of political difficulties around this, and they are lurking here and there in the debate, right? And in particular, also, if you read through this report from EY, the big debate that's in the background is the one of corporate purpose, right? Of directors' duties. Who is the one that the corporation should serve, right? And it's not a long-term, short-term debate, but this is the one of what are corporations actually supposed to do. Now, you know, most people will know that there is no common standard, and there are strong political battles over this. Previous attempts at harmonizing something like this in Europe have utterly failed. And why is that? Because some countries have long believed in a stakeholder approach, right? The German Corporate Governance Code is an example in point here, which has long stated that the company should take into account the interests of shareholders, employees, and other stakeholders with the objective of sustainable creation of value. Contrast this with other countries, you know, the Milton Friedman approach here of shareholders, full stop, right? And then you have other countries. Oh yeah, maybe the US is coming in nicely here, but there is a big debate going on corporate purpose. As people will know, this is the Business Roundtable statement, and the guy in the little picture here is Larry Fink. So there is a big reflection on this going on in the United States. And the third group of countries is then somewhere in between. The UK may be an example here. We have directors' duties for the members as a whole, but in doing so can take other things into account, like long-term things, employees, suppliers, customers, and others, right? But so what I'm saying is that there is no harmony on this in Europe, and it has to do with political battles as well. And this is a graph from the consultation showing you the different approaches to the purpose of corporation and the ultimate objective of those ESG goals within the corporate governance framework. So it's very hard, it will be very hard to reach a common agreement on all of those things. Maybe the final question I want to ask then is the heretic one, right? Does it really matter? Does all of this really matter to regulate? Should we really regulate and intervene in the purpose or a director's duties, as the European Commission is suggesting here? Well, as we know, luckily, some countries already have de facto a stakeholder approach, right? And Germany has one for a long time, but there's de facto no case law on this, right? There are in the last decades, there are three court decisions where this was mentioned in passing, right? Where they just had an obiter dictum. By the way, we just want to say we take the opportunity, right, to say that yes, directors' duties are owed to stakeholders and the enterprise as a whole, right? But there was no legal moment really in corporate history in Germany where this really played a decisive role in the outcome of any significant litigation. Does it matter in the other group, right, in the shareholder value jurisdictions? Well, I don't think so, right? The business judgment rule is well known. Directors have a very wide discretion if they took decisions in good faith and if they went through a number of procedural steps. So that protects them amply, right? I told you already, private enforcement is low, so it doesn't really come to court at all a lot. And in any case, I think it's very easy for any director to argue that the decision that was taken will indirectly benefit shareholders. So you can do something nice to employees or creditors if you can argue that, yes, but in the long run, right, this will be a shareholder value or shareholder wealth and maximization ultimately. And final point, we of course want directors to take risks. I mean, we do not want to kill any risk taking. It's also something that we should take into account in this debate. So drawing all together, I think what I'm trying to convey here is that the objective of the European Commission is laudable, but the formal tool that they're trying to apply to fiddle around with directors' duties is, I think, less important. If they do anything here, the most I would expect is a symbolic step here, right? I think the much more promising move would be to support investor demand for sustainability. And if that is something that we should encourage, then facilitative regulation rather than restrictive one would be much preferable in comparison. Final thing, it's important whenever you play around with one thing to look at the context, right? As I've explained, it hinges a lot from a legal perspective on enforcement, on litigation rules, on costs of litigation, on who has standing, right, to enforce all of this. It also matters, of course, what do we say about board composition, right? Who sits on the board is maybe much more relevant than who the formal duties are being owed to. Maybe there is a case of having somebody who is responsible for sustainability on the board just to keep the topic in the discussion alive. And final considerations, remuneration, selection, all of these things are relevant. So I think, in summary, that this discussion is great, and it's fantastic that we're having this conference. But this consultation here and this report really are a very, very first and tiny step to a much bigger problem. Thank you very much.
Thank you very much, Georg, for adding some missing pieces to the puzzle and adding interesting features to the discussion. We now have two research members of ECGI who will discuss the issues at stake. Today, in alphabetical order, we have first John Coffey, the Adolph A. Burley Professor of Law at Columbia Law School, and Oren Sussman, who is a reader in finance at the Oxford Said Business School. So, Jack, I would give the floor to you first.
Good morning. Am I unmuted? Okay. I'll give you a nutshell of where I'm going to go. I think the EY report on sustainable corporate governance is addressing a legitimate problem. Okay, and its evidence is relevant but not dispositive. On the other hand, I'm afraid the EY report has remedies that are only tangentially and tenuously related to that problem. Bluntly, EY has missed the forest for the trees. The real problem, I submit, lies not with directors, who are not committed to short-termism, but with shareholders, or more accurately, with the professional institutional intermediaries who represent the ultimate beneficial owners of the corporation. And here it's important not to paint with too broad a brushstroke, because there are all kinds of shareholders. And increasingly, we see different groups of shareholders at the polls. On one side, as you all have heard, there are the activist shareholders led by short-term oriented hedge funds, and they tend to be hostile to sustainability and very committed to shareholder primacy where they can influence things. On the other side, we have the asset managers who are diversified, even indexed, and they tend to support sustainability policies. They tend to vote for climate change proposals, and I think they are the natural ally of sustainability. Sometimes these two sides do partner, and that's to be encouraged. Sometimes they're opposed to each other, but we have to focus on that a little more detail. Now, let me start with the evidence that there is a problem. The EY report chiefly focuses on the upward trend in shareholder payout and the downward trend in capital investment and research and development. And there are lots of studies that do find a decrease in research and development as activist investors assert themselves. This is, again, alarming, but not dispositive. Much depends on how easy it is to raise equity capital, and I think even more importantly, how broadly equity capital is being raised. If equity capital gets raised easily in England on the London Stock Exchange, but not at all in other parts of Europe, we have to worry about the future of industry in other parts of Europe. Now, aggravating the problem, and this is what's more interesting to me in the data cited by E&Y, is the number of companies where the payout ratio, the ratio of payouts to revenues, now exceeds 75%. That number has soared. In a few countries, Slovakia and Belgium most notably, the payout percentage appears now to be in excess of 100%, with the result that these companies are effectively dismantling themselves. Now, I fully recognize that a neoclassical finance professor will get up here and say those ratios are signs of efficient financial discipline, that is, forcing the company to pay out its free cash flow and preventing inefficient empire building. But if you have companies over 100% or just over 75%, Europe should worry about whether it is going to gradually downsize itself so that it no longer belongs on the same stage with the United States or China. There is a problem here, and it's not answered simply by saying there has been in the aggregate substantial equity issuances. Now, what is causing this high payout ratio? An initial cause is the popularity of stock buybacks. Behind that cause, stock buybacks, lies a deeper cause, pressure from activist shareholders and the tax advantages to shareholders of buyouts over dividends. Now, what solution does the E&Y report discuss in this light? Let's very briefly survey four. First of all, they want to abolish quarterly earnings and discourage earnings guidance. This is in effect asking shareholders to wear a blindfold. In response, shareholders will seek information. They will turn to securities analysts and selective disclosure will become prevalent. The market will probably become more volatile. Insider trading is more likely. In any event, wealthy shareholders will find a way to pay for the information they want using analysts and others, but retail shareholders will be left in the dark. Don't think this is the way to go. Next proposal, they want to restrict executives so that they cannot sell shares that they receive as compensation, at least for a lengthy period. Now, there could be some possible merit in this, but I do think it's going to destabilize the executive labor market and lead to a migration of executives from European firms to less regulated American firms. If at the same time you are changing the pressures on shareholders and directors and also changing compensation for corporate executives, you may be making Europe less competitive if all these things are imposed on European corporations at once. Anything you do to executives is not going to change shareholder preferences. Shareholder preferences and the incentive of hedge funds for short-term campaigns, for short-term results, is not going to change by a change to executive compensation. Next proposal, change the composition of the board by, in particular, requiring greater gender equity. Now, personally, I greatly support greater gender equity, but of all the reasons that have ever been given for greater gender equity, this is probably the poorest. The stereotypical assumption here is that females favor sustainability over profit, and that will prove false if the new directors added to the board are chosen by a nominating committee of the existing directors, and that's the pattern all over the world, that the board chooses its new directors. The existing board can always and easily find female directors who share their faith in shareholder primacy and possibly their tolerance for short-termism. Okay. By the way, and I say this facetiously, of course, if you really want directors who will faithfully favor sustainability, E&Y should have recommended a mandatory vegan director. That might have some impact, but I don't think anyone's going to pursue that proposal. Finally, the EY report stresses changing the legal rules to which directors are subject, in particular, stressing sustainability criteria and a duty to stakeholders. Although I do not object to marginally, and I underline the word marginally, changing the legal rules to which directors are subject, I am convinced that the gains from this approach are very modest and probably more symbolic than real. Existing legal rules in the United States, for example, do not even tell directors that they must maximize shareholder value in the short run or that they must maximize shareholder value at all. And that's the US, which is the home of shareholder primacy. Delaware requires shareholders to requires the board to maximize shareholder wealth only when the company is up for sale. That's the so-called Revlon rule. And in other US jurisdictions, the Revlon rule is not followed. Frankly, the manner in which directors behave is much more determined by custom and ideology than by legal rules. And in the US, directors believe that they have a duty to maximize shareholder value, even though the legal rules don't quite say that. A second problem with putting much confidence in modifying directors' duties by law is that only in the US do we have litigation enforcing these duties. European law does not threaten directors with liability in the way that American law does. As you're aware, the US has a comparatively hyperactive litigation system whose defining elements include class actions, contingent fees, punitive damages, jury trials, and very little fee shifting against the plaintiff. But even in that world, the US does not enforce the duty of care with litigation, but rather makes it non-actionable. Thus, even in the home of shareholder primacy today, no one is trying to enforce this kind of duty with litigation. I'm not advocating that you should not consider modification of directors' duties. I think it has symbolic value, but careful corporate lawyers will predictably guide directors so that they will make all the necessary findings and satisfy all the procedural requirements that you impose on them by law without changing any substantive outcome. Assume that directors can find ways to keep doing what they want to do based on the advice of very good lawyers. What then could work? And here I'm going to go outside the E&Y report. Well, first, if buybacks are the short-term problem, if they seem to be the initial cause of short-termism, here is a simple remedy. Why not use the tax law to chill buybacks? If shares sold in a buyback were taxed at a higher rate than shares otherwise sold, shareholders would be less likely to demand or to want buybacks. Now, this is an example of Occam's razor, which I think has been generally ignored in this report. And Occam's razor suggests we should use the simplest remedy with the fewest moving parts. Similarly, if short-termism is the problem and is encouraged by activist shareholders who invest in the company for only a year or two, which is the US experience about hedge funds, consider something like tenured voting, a system under which longer-term shareholders receive more votes. Silicon Valley has long known that the simplest way they see to prevent short-termism is the use of dual-class capitalization, which has to be installed before the IPO. Personally, I am not a fan of either option, dual classes or tenured voting, but I do think a modest and capped tenured voting system is thinkable, and it's a relevant response to the problem. Now, my preferred strategy would focus on shareholders, a topic largely ignored by the EY proposals. Here, there have been major changes. No one's mentioned this, but there's been extraordinary concentration among shareholders in the last decade. In the US, ownership now is so concentrated that the so-called big three, BlackRock, State Street, and Vanguard, own 20% of the equity in listed companies and vote 25%. More importantly, the big three tend to regularly vote in common and to support climate change and other sustainability proposals, at least sometimes. All three are also permanent shareholders who do not exit the company when they have compelled a change in policy, as exit funds do. Exit funds will often launch a proxy contest and leave after they are successful and the stock price has responded. Now, there is evidence that the big three and other long-term permanent shareholders can really have an impact. A leading example occurred in 2018 when a coalition of the big three and others compelled Royal Dutch Shell and British Petroleum, both European companies, to reverse long-held positions and significantly advance the date at which they would achieve carbon neutrality. Royal Dutch Shell fought this kicking and screaming to the last battle, but effectively, the big three had a gun to their heads and they had to agree to very significant changes. That is a typical kind of change. Now, even more interestingly, and I detail this in a paper on SSRN, the big three and other institutional shareholders seem to be moving in the direction of voting based on their overall portfolio and not on a stock-by-stock basis. Thus, for example, if you're looking at your overall portfolio, you might favor a proposal to force a company to give up on dirty energy and only use clean energy. You can do that, justify that, because it may hurt that company, but it may benefit 8 other companies in your portfolio. The significance of this, as others have recognized, is that it gives the large diversified investor an economically rational incentive to curb externalities and to favor sustainability, at least when the gains to its portfolio will involve more companies benefiting from the change than companies harmed by the change. And that can often lead to a justification for imposing climate change restrictions. In marked contrast, and this is sort of my last point, in marked contrast, activist hedge funds today have done the opposite repeatedly. Let me give you an example, which I discuss in one article. Elliott Management, one of the very largest of US hedge funds, objected in 2017 when NRG Energy, the second largest producer of electricity in the United States, announced with considerable fanfare that they were going to move from a dirty energy policy to a clean energy policy and give up on using coal. In pursuit of that goal, they quickly began to buy wind-powered companies and solar power companies, and their stock price began to fall. Well, what happened? Elliott didn't like this policy change, and it led a proxy fight, and it replaced most of the board of NRG Energy and forced it to return to a dirty energy policy. Here we have a very simple example, an anecdote you will say, but a very simple example of an anti-sustainability policy being implemented by an activist hedge fund. Those other examples like that can be identified. It just shows what can happen, that we have two sides among shareholders, some actively pursuing sustainability, some actively opposing sustainability. So we have a division, although the parties on both sides can sometimes agree. What kind of reform would be relevant? Maybe the board should have a committee on sustainability, which would regularly consult with both its allies and its enemies. And its goal would be to try to develop support among its permanent shareholders, the asset managers, the big three and others, to see if they will agree to policies and pressure for policies that the board is willing to live with. More importantly, and lastly, if we wish public corporations in Europe to be able to resist short-term pressures, the simplest approach might again be the use of the tax laws, to tax at a higher rate sales where the fund has held the stock for, say, 3 years or less. This is just a hypothetical. That would discourage the in and out fund that wishes to hold only for a short term, which is the profile of the activist hedge fund. But it would not at all adversely affect the so-called permanent shareholders, such as BlackRock, State Street, and Vanguard, and the other diversified and indexed long-term holders. Paradoxically then, institutional shareholders are both the leading allies of sustainability and the leading enemies of sustainability, and they are both advancing and fighting negative externalities. Given this division, I think that it's time that the law should pick its favorite side and try to support the permanent shareholders and try to put some barriers in the path of activist funds that want to make a very quick turnaround in corporate policy and then exit. I'm not trying to disenfranchise the activist fund, but I'm saying the idea of coming in, pushing through a proxy proposal and leaving within a year and a half is not something we should encourage or subsidize by having the tax laws and effectively support this policy. So using things like the tax laws, I think, is the most promising avenue. On that note, having told you that we have to break down the shareholder class and look how they subdivide, I'll turn it over to others. Thank you very much.
Thank you very much, Jack. We are running a little bit late now, but it's for Oren now to take the floor. You're muted. Oren, you're muted. Still muted. Okay.
Okay, so thank you very much for inviting me to discuss this report. This report starts with a focus on short-termism. Unfortunately, without giving any clear definition for short-termism, what short-termism is, it seems that the report is aware of that because in the first pages of the report, short-termism comes in quotation marks, but then get tired of the practice and drops the quotation mark. But when you read further, you realize that the driving force of the report is really not short-termism in the precise sense that Zach has discussed it, which is the way management is accounting for present relative to future cash flows. But it is interested in completely other things, mostly environmental concerns, to some extent income inequality, tax avoidance, R&D, and probably a few other things. So I want to clarify that all these problems, environment, income inequality, tax avoidance, R&D, are very, very important in my mind. I'm not dismissing any one of them. They are terribly important. But I'm going to ask the question whether there are really corporate governance issues. Instead of a clear definition, the report jumps straight to certain variables that it measures, with, in my view, disproportional focus on payout ratios. It then analyzes the trends in payout ratios, but not in a way that can factor out the various causes that affect the buyout. For example, John Coffey talked about tax incentives. Another one is very clearly just the interest rate. And the interest rate, to some extent, was affected by monetary policy, which, at least to some extent, is the effect of the European Central Bank. So, to some extent, this is what is going on here. What is going on here is just trade-off between various targets of policy within the European Union. So, as I said, I'm not convinced that the big concerns of the report, primarily environmental, are a corporate governance issue at all. Actually, when you read the report, there are plenty of references to the report being irritated by managers responding so easily to shareholders and to market signals, which is, you know, if managers are so responsive to shareholders and market signals, then probably corporate governance works quite well. Maybe there's room for refinement in the direction that Zach has elaborated on, but on the whole, corporate governance seems to work. So if this is not a corporate governance problem, what is it? Well, I think that simple economics, and when I say simple economics, I mean very simple economics, indicates that these are just market failures that need to be addressed by primarily corrective taxes, or as we call them in economics, Pigouvian taxes. Things like carbon trading for the environmental, social mobility funded by taxes for income inequality, and obviously removing taxation loopholes. On that, we have to remember that the European Union can actually be proud of the fact that it has the most elaborate carbon trading system in the world, the one with the broadest coverage, and almost the highest tax which is actually imposed. This system is now in operation for more than almost 20 years. There's plenty of evidence that it works, perhaps not enough evidence, but quite a lot of evidence that it works. You may think that the level of tax that is imposed via the carbon system is not enough, but this is just a matter of calibrating a machine that already works and is there for you to be used. Now, I want to say a few words about why it is so obvious that economic analysis recommends Pigouvian taxation rather than tweaking with corporate governance. Well, first of all, because Pigouvian taxes will affect the profit motive of the firm. And then regardless if these are activist shareholders or mutual funds, there will all be, even the Elliots of the world, as John Coffey just mentioned, will be affected by the profit motive and will respond to it. So why not use the first order effect in the operation of any shareholders, regardless of its identity? The second reason why Pigouvian taxes are so much more effective is that they deal with the root of the problem rather than track its effect into thousands of secondary markets. And the way this is being done, the basic effect of the lack of incentives on emission is permeating the whole production system, whether this is automobiles or whether this is aircraft or whether this is heating or just plain industry. It's very difficult to track the effect, and the taxation at source allows you to avoid the problem. Related to it is the fact that directors are probably don't have the expertise to track all these effects in so many markets. Here's an interesting anecdote. In 2019, Warren Buffett decided to invest $30 billion into wind turbines located in Iowa. And the Financial Times approached him and said, "This is wonderful. You are now into ESG, and this is great." And Warren Buffett said, "No, no, no, no. I'm not into ESG. I just responded to profit motives." And this is not because I'm a bad person who doesn't care about the environment. It's because with all my experience and with all the boards that I sat on, I don't know. I can't do the arithmetic that will track the effect of two competing decisions that I have to make with respect to their environmental effect. Another anecdote, perhaps even less grand than this one, a colleague of mine who's a very good economist is married to an environmental economist. And one evening they started a debate at home about what is the environmentally efficient way of making a cup of tea. Is it by using the hob or using an electric kettle? And after discussing the problem for a few hours, they reached the conclusion that they don't have enough information to answer the question. So imagine a board of directors that has to make an investment decision that needs to track all these effects in all these thousands of markets. Completely impossible. The last thing I want to comment on is a bit the political context of this debate. So CSR, ESG, purpose, these names come and go, like to present themselves as a progressive kind of politics. I want to say that in my view, this is one of the most conservative agendas around. And the reason is very simple. It is that if managers, if directors in companies, after tweaking a few legal documents and putting some words on their websites, can already internalize the social good and get rid of all these externalities, then the implication is that externalities is not a serious problem. That the markets can, in one way or another, internalize everything. The conflicts of interest between the public and the directors, to a large extent, don't exist. And therefore, we can resort to very minimal intervention in markets, even in areas where I think it's quite obvious, like global warming, where the intervention in the market has to be massive and has to be coordinated by governments. Here's another piece of anecdotal evidence that I find interesting. Caroline Lucas, the MP for the Green Party, was interviewed a year ago by Andrew Marr for the BBC. And the first question was, do you fly? And she said, yes, I have a son living in the United States. I want to visit him and I fly. And then she explained why the question is irrelevant. It is irrelevant because the whole focus on individual action is completely wrong. What needs to be done is to change the market signals that feed into the profit motives of firms that will really have an effect on how firms behave. So the lines, to some extent, between progressive, so to speak, policies and conservative policies have completely been blurred. Here is Caroline Lucas in a kind of very anti-establishment pose, but speaking in a language that will make any Chicago economist feel very, very comfortable. Personally, I think that Caroline Lucas got it right. And the politicians who are playing with all sorts of secondary or third order effects are not going to progress a solution, and to some extent are wasting their time on the wrong measures. Thank you, Luca.
Thank you, Oren. Thank you for giving us these insights into some first principles of financial economics. And now we have time for Q&A. I already have Mark Rowe lined up to speak, and you have the Q&A box as attendees if you want to ask questions. So please feel free to do so. But in the meantime, Mark, the floor is yours. And then I would give back the floor to Zach for a response.
I hope I've unmuted my mic, which sometimes I forget to do. Okay, I see a nodding head. I wanted to compliment Zach on a terrific keynote address on the evidence and how much evidence that there is out there for short-termism. It's the kind of thing that we kind of wish the EY report had done and done on both sides. I have a couple of questions about how we assemble this evidence for and against. So I'll just focus on one item. I mean, I kind of wish we had an hour to talk about it. So we brought up the Asker study, which I'm really glad you did, because it's, in my mind, it's one of the 2 or 3 most significant studies showing that there's a potential short-term issue. And for those in the audience who haven't read it recently, it's kind of, we matched samples, the authors matched samples of private firms, public firms that are approximately the same size, approximately the same business, and so on, and find that the private firms invest more than the public firms. And that led in the summary to red light. We've got evidence of short-termism. In the last couple of years, last several years, there have been a couple of other studies post the Asker study. One from Friedman and co-authors using tax data, US corporate tax data, that finds the opposite, that actually the public firms are investing more, which is kind of what corporate lawyers tell their clients in the United States. One of the reasons you've traditionally wanted to go public is better access to financing. And then there's also this Maximovic study. There's a problem with the match sample, which Asker et al., because they're first-rate finance economists, absolutely know, which is when you're matching firms of similar size, private firms are usually smaller than public firms overall. And there's a risk that what happens in the study is the really powerful public firms outgrow the match sample. So if you're matching, say, internet booksellers, one on the private side and one on the public side, you're not going to include Amazon in the match sample because it just blows out from the sample set. Yet in evaluating the investment capacity of public versus private markets, you'd want to include that. So in the bottom line slide this is red. This is private versus public is showing that there's a major short-termism problem. And so the question I have is, how do you decide which are the high-quality studies and which are the low-quality studies? Is the Friedman study because of the co-authors or because of the study, because of the outcome, a low-quality study? And is the Maximovic study a low-quality study? Because at least my view as an amateur finance economist, they kind of all three look good to me. And with 2 out of the 3 pointing in one direction, I'd at least have turned the red to a flashing yellow. Thanks.
I think these are great points. I mean, I fully agree in what you say. Just because I think running out of time, and because everything said makes a lot of sense. Just 2 points. First, of course, there was limited time, limited space, so I was trying to use my guiding principles and see what papers went to the refereeing process. But that's not to say these others are fantastic studies as well, fantastic authors. So therefore, I think the way forward is rather to understand what the differences between private and public firms are in terms of the forces that may cause these differences if they are there in investment, right? So that's where compensation comes in, reporting requirements come in, analyst targets come in. So these are lots of aspects that are not so present in the private firms, and therefore I think it's so crucial to understand these aspects rather than just do a crude comparison of private versus public firms.
Okay, well, thank you. I'm quite puzzled to see that we have no questions. There is only one in the Q&A, which is a response to a response that I gave Konstantin van Artsen about topics that Oren also covered. So maybe we are talking about second order issues here, and there are other tools that policymakers should use, and perhaps they are a little bit too obsessed with corporate governance as remedy to these issues that are much broader and much more existential than perhaps any individual company can tackle with its own individual actions. Konstantin asked whether are the theories of corporate governance, CSR, and sustainable finance able to imagine what a sustainable economy might look like? If not, then should we use them to evaluate sustainability related reforms? So this is again broadens the pictures and leads us to consider other policies. I see now that Holger Spamann raised his hand, so I'm happy to give the floor to him.
Okay, I'm sorry, I was just too stupid to use the right technology with the hand raising. I wanted to ask Zacharias on the evidence. Now, the evidence you've presented is about the presence of short-termism, but in a policy discussion, in a way that's maybe not the exactly right question to ask, because I saw also somebody posted in the chat the point that, for example, when you have vesting, The fact that there might be short-termism around the vesting, well, the only way you can get rid of it is if you never have vesting. So presumably at some point we need to have vesting if we want to have, pay with equity incentives. And so one might say that at least some of the evidence you have presented, it's very interesting. I thank you for the great exposition. It's not exactly on point in the sense that when we ask, what should be done, can we actually fix it, or is this just a necessary friction that we can't eliminate?
I think, Holger, great points. I think two responses there. One response is there are different ways how you can make equity vest, right? There's cliff vesting, there's graded vesting, right? So if you have cliff vesting, which is still used in lots of companies, these problems are more severe, right? So you want to think about how to spread the vesting over time. I think that's important. And second, I think it's important to understand that if a lot of equity vests, even if you have graded vesting over time, that the board pays particular attention to these incentives that arise because of the vesting, right? But also, lots of companies still do not have a lot of deferred compensation, right? And I think that's one takeaway, right? Think carefully about how you can create a reasonable vesting structure in the equity compensation.
Thank you. In the meantime, the Q&A has been populated with questions. There is one for Georg Ring about the relationship between director duties in continental jurisdictions and their enforcement. And the question by Pavel Schlup is it possible to interpret them more broadly in order to increase their enforcement by shareholders and foster sustainability that way? I would add to this that the European Commission is also thinking about granting standing to sue to other stakeholders. And I think that the irrelevance argument that Georg and Jack made before might not hold so strongly if indeed this policy is implemented. If you grant environmental associations a right to sue directors for not having put in place the necessary arrangements to manage the risk of an increase in the global temperature, then I don't know I don't know whether they can win the case, but they can definitely bring it and possibly lead to changes, at the very least, as Jack said, that will imply the costs of hiring lawyers and experts to have something in place that will be sufficient, or hopefully sufficient, defense against these actions, perhaps with little impact on climate change and so on. So, Georg.
Yeah, just briefly. So I take the point, Luca, that enforcement is relevant, and I think I agreed in my presentation also with that. It's just that under the current framework, that incentive of enforcement isn't there, and enforcement level are very low. Well, if you give standing powers to pressure groups and environmentalists, that would be a very different thing, but they would have their very own agenda, right, which is not necessarily aligned to furthering the corporate purpose. So that's a very different story. What Pavel is writing in his comment in the chat is a different thing. So you are arguing, I understand it, that you want to broaden the standards of director duties, which I'm not sure I agree with, because if you broaden them, right, then enforcement will be even more difficult, right? Because they have a lot of leeway. They have a lot. I mean, there's even the argument, right? If you broaden the obligations of directors, then you have so many that it's impossible to comply with all of them. That may even lead to deadlock in the corporate board, which you ultimately do not know whom to serve. Right? That's the ultimate purpose. So I think the enforcement question is an important one. If we want to tackle it, then yes, we need to think about other things that are outside of the corporate governance framework, like standing, like incentives to take action, and probably don't want to move towards a litigation system that Jack has described in the US. But that would be the way to think about it in the European context, I guess.
Okay, so we reached the time when we leave the floor to Marco Becht for conclusions on the first day of our works. I think it was a productive set of presentations that we had, and a good Q&A session. But Marco, please.
Thank you, Luca. So I'll be very brief. I think we started by putting the whole discussion into context, and I emphasized that it is a very important discussion that's going to occupy us for some time to come. Now, Zach started off by giving us a proper definition of what financial economists mean by short-termism. And I think Mark Rowe pointed this out in his last intervention. So we have that now, and we'll continue to debate this and discuss this in more depth tomorrow and the day after tomorrow. And my prediction is it will not finish there. Now, if you want a summary of what short-term, how to think conceptually about short-termism, I recommend you go back to Zach's cardboard drawing, the photo of his cardboard drawing, which I thought sets this out conceptually very well. Zach also told us what the state-of-the-art empirical approach to this is. You have to try and get, when you talk about policy making, you have to try and get to causation. Correlation is not good enough. It's very challenging. We mostly do it with US data. He hasn't talked about European studies. Of course, in Europe, we have families. What is the story with families? He did start talking about private markets, so private equity. So I think there are other things to explore here if we're just simply talking about short-termism. Now, the other question that came up, and I think Oren brought this up most clearly, is did the Commission really ask the right question when they commissioned EY? And if you go back to the beginning, and I spoke about when God created heaven and earth, what was the original sin here? And maybe if you put it in this way, the original sin was the question that the high-level group asked in Action 10, because they didn't ask, what is the role of corporate governance in potentially mitigating and achieving the Sustainable Development Goals and mitigating climate change? But they said, we know it's short-termism, so please tell us about short-termism. But I think several of the speakers today said, maybe it's not short-termism at all. Or maybe it's a bit of short-termism, and short-termism, depending on what we think about short-termism, is, related to it. But, why don't you ask the question directly? What does corporate governance have to do with the thing we're really talking about, the problem that we're trying to address, which is Europe's contribution to climate change and to achieving the Sustainable Development Goals? And I think several of our commentators started to talk about this as well. I think Jack Coffey, I heard him say, and Georg as well, that maybe we're actually behind the curve on this. Because if you look out what's happening in the world, we have a rise in index tracking funds that internalize externalities they care about the world, if you're a global tracker. And we have things like PI, we have things like Climate Action 100. There is pressure on companies. Now, even hedge fund activists, if you look at the latest cases, some of them are starting to paint themselves green. They engage with companies on climate objectives. And you can then ask the question, why are they doing this? Is that because they've suddenly discovered that, they've become tree huggers? Or, maybe they've actually got the message that they need to do this because there's no place on earth to hide. But maybe, and Patrick Bolton showed last year another paper that shows that actually climate risk is starting to be priced in. Maybe it's actually rational for them to do so. Because you can actually make money doing this. So I thought that was the actual second discussion which we started, which is what's the actual role of what's the contribution of corporate governance to what the ultimate goal of this whole exercise is? And of course, if you think back to what Lucas said about the consultation that's going on at the moment, that's the question that's being asked. It's the European Green Deal, and it is making Europe work for people. What's the contribution of corporate governance to this? Now, So to be fair to EY, I'm saying that's my personal interpretation. They were asked a confusing question, and I think Oren brought this out because they were asked about short-termism, but they were also asked about the larger goal, and the discussion therefore also maybe got a bit confused. Now, I think we are so I took away from day one that we are being very clear and that we are discussing two different topics here. And short-termism itself, and I predict we'll hear more about this tomorrow, is an important topic in its own right. So we'll continue discussing this. And Zach gave us a great start, and everybody else today. But we shouldn't lose sight of the overall question, which is what is the role of corporate governance potentially to improve sustainability and to make sure that there's a future for our children. So with this little note, I look forward to welcoming you all back to day 2 of our policy workshop tomorrow afternoon in Europe and in the morning in the United States and in the middle of the night for our friends in Asia. Thank you, Luca.
Thank you, Marco, for these excellent concluding remarks, and see you hopefully tomorrow.
Thank you.
Thank you. Bye.
Thank you, and all the speakers.